This unit covers several unique accounting situations relating to governmental accounting. Our objectives are: 1. Understand the accounting and financial statement presentation for several unique situations to include leases, landfills, compensated absences, capitalization and recording for art, historical treasures, and similar assets, to include exception conditions, infrastructure assets such as bridges and sidewalks, and maintenance costs used in lieu of depreciation for infrastructure assets. 2. Describe the three distinct sections of the general purpose external financial statements. 3. Be able to understand and explain the concepts of primary government and component units, and when component units are discretely presented or shown as a blended unit. And 4. Explain the method by which governmental accounting rules are applied to public colleges and universities. It should be noted that lease accounting is covered in detail in the Intermediate 3 accounting course. Governmental accounting uses the same 4 criteria applied by FASB to identify a capital lease. 1. The lease transfers ownership of the leased property to the lessee by the end of the lease term. The lease contains an option to purchase the leased property at a bargain price. 3. The lease term is equal to or greater than 75% of the economic life of the leased property. And 4, the present value of minimum lease payments equals or exceeds 90% of the fair value of the leased property. Both the asset and the lease obligation will be recorded. For operating leases, government-wide financial statements do not record an encumbrance. They record an expense when the lease payment is made. For fund-based financial statements, we record the encumbrance. An expenditure is recorded when the lease payment is made. Accounting for landfills gives us several unique accounting situations. In the governmental funds, if the landfill is open to the public without a charge, it is recorded in the general fund. If a fee is charged, the landfill is recorded in a proprietary enterprise fund. Regardless of what fund it is recorded in the government-wide financial statements, the expected cost to eventually close the landfill is recorded on a prorated basis as a percent of capacity used. For example, if 25% of the landfill is filled in the first year, 25% of the estimated cost to close the landfill will be recorded as an expense and a liability. This matches estimated cost with the revenues during the period the waste is accepted. Here is an example. The landfill is expected to cost $1,200,000 and has a 10-year life. At the end of year 1, 15% of the landfill has been filled. The accounting entry will be a debit to expense landfill closing for $180,000, 15% times 1,200,000, and a credit to landfill closure liability. In the fund-based financial statements, if the landfill is operated as an enterprise-wide fund, the reporting will be the same as the reporting for the government-wide financial statements. A debit to landfill closing for $180,000 and a credit to landfill closure liability. If it is recorded in the general fund, no fee charge, there will be no entry to record because there is not yet a claim to any current resources. If the town starts putting some cash aside for the eventual closing, then the funds would have an entry debit expenditures landfill closure and credit cash. Government employees earn vacation days, sick days, and holidays throughout a year. They are known as compensated absences and must be accrued in the government-wide financial statements. Generally accepted accounting principles calls for these absences to be accrued if all four of the following conditions exist. One, the obligation is attributable to the employee's service already performed. Two, the paid absence can be taken in a later year. Three, payment is probable. And four, the amount can be reasonably estimated. Compensated absences are covered in intermediate accounting too. For example, if the town allows its employees to carry over unused vacation time up to 2 weeks, and the amount is estimated to be $500,000 at the end of year one, the following accounting entry will be made for the government-wide financial statements. Year one, wage expense, $500,000 debit. Wage payable, $500,000 credit. It is expected that $125,000 will be paid during January and February of year two. In year two, when paid, the following entry will be made. Year two, wage payable, $125,000 debit, cash, $125,000 credit. In the fund-based financial statements, if it is recorded in an enterprise fund, the entries will be the same as the entries for the government-wide financial statements. In the fund-based financial statements, if it is recorded in the general fund, the entry in year one is considered a claim on current resources and will be recorded as year one, wage expense, $125,000 debit, wage payable, $125,000 credit. In year two, when the payment is made, the entry will be recorded as year two, wage payable, $125,000 debit, and cash, $125,000 credit. Governmental accounting for works of art and historical treasures presents several accounting issues to work out. Artworks, historical treasures, and similar assets should be capitalized at the cost to the government entity or fair value at the date of donation in the government-wide financial statements. A piece of art donated that has an appraised value of $50,000 would be recorded as a debit to the asset artworks for $50,000 and a credit to the revenue account donation revenue for $50,000. For fund statements, the accounting is the same if the item is set up in an enterprise fund, if a fee is charged. For fund statements for a non-enterprise fund, there is no entry unless the artwork is paid for. If the government entity pays $5,000 for a piece of art, the entry would be a debit to expenditure for $5,000 and a credit to cash for $5,000. GASB 34 made capitalization optional if all of the following three criteria are met. 1. Item is held for public exhibition, education, or research in furtherance of public service rather than financial gain. 2. Item is protected, kept unencumbered, cared for, and preserved. And 3. The item is subject to an organizational policy that requires the proceeds from sales of collection items to be used to acquire other items for collections. If capitalized, depreciation is not required if the work of art is considered to be inexhaustible, such as exhibits whose useful lives are diminished by display or educational or research applications. Newly acquired infrastructure assets, such as roads, bridges, and sidewalks, should be capitalized at historical cost in the government-wide financial statements and recorded as expenditures in the fund-based financial statements. Major general infrastructure assets put into service since 1980 must also be capitalized, although an estimation of current book value may be necessary. Depreciation of all capital assets other than land and inexhaustible artworks is required so that infrastructure items are also subject to depreciation. Let's discuss recording infrastructures, bridges, roads, sidewalks, etc., in the government-wide and fund-based financial statements. Besides recording all newly acquired infrastructure assets, state and local government entities must capitalize all infrastructure assets acquired prior to the establishment of the government-wide financial statements. Because cost figures most likely are not available, this requirement is limited to those that were acquired after June 30, 1980, or that had major renovations, restorations, or improvements since that date. Approximate cost may be used. In the fund-based financial statements, acquisitions will be recorded as an expenditure. For government-wide financial statements, depreciation is recorded for all assets except land, artworks, and historical treasures that are inexhaustible. GASB does allow an alternative for infrastructures in lieu of depreciation called the modified approach. We will discuss this on the next slide. GASB 34 provides an alternative known as the modified approach, which eliminates the need for depreciating qualified infrastructure assets. The modified approach allows the expensing of maintenance costs in lieu of depreciation for infrastructure assets if certain criteria are met. A minimum acceptable condition level must be met, and documentation must be provided to show that this minimum level has been maintained. And an asset management system must be in place to monitor the particular system of assets. The cost and record keeping have so far limited adoption of the modified approach. For governmental accounting, a primary government, such as a city or town, is a reporting entity that normally produces a comprehensive annual financial report. In addition, a special purpose government, such as a school board or water commission, qualifies as a reporting entity if it meets the following three criteria. One, it has a separately elected governing body. Two, it is legally independent. And three, it is fiscally independent of any other state and local governments. Component units that meet either of the following two criteria should be reported within the primary government financial report, even though they are independent operations. It must be physically dependent upon the primary organization, or the primary government must appoint a voting majority of the governing board and either be able to impose its will on the component organization, or the component organization provides a financial benefit or imposes a financial burden on the primary government. Once identified, component units can be discretely presented in a separate column to the right of the government-wide statements, or blended with the primary government as if it made up a part of the primary organization. The government entity comprehensive annual financial report is divided into three distinct sections. One, management's discussion and analysis, the MD&A, which provides a broad range of information to help decision makers evaluate the operations and financial position of the government entities. Two, financial statements, which are the government-wide financial statements and the fund-based financial statements. And three, notes to the financial statements that include the required supplementary information. Public colleges and universities must follow the same guidelines as state and local governments. GASB retains the primary reporting authority. Their statements will differ from those of private colleges and universities who are following FASB accounting standards. GASB 35 requires the application of GASB 34 to public colleges. However, many of these schools assume that they function solely as an enterprise fund, open to the public for a user charge. Thus, these schools are allowed to produce fund-based financial statements without the need for government-wide statements.